March 18th, 2024. We got a measured move down today. I always say if you get a spike in the opening range, you should be looking for a measured move up or a measured move down of it. And today you can see we got within a tick or two of the measured move down. So I think that's what this vacuum test late in the day was. It was just trying to test that measured move. So you always have to be aware of the potential opposite side because you see a strong bull spike and you start thinking about the measured move up. But when you start to drift sideways to down, you have to start thinking about the measured move down. I think these kind of days are the hardest for stop order traders. You have trading range days like this that I don't think any of these entries are really all that tempting. A lot of the ones that end up, getting you trapped, they don't seem all that tempting. But I think today had a lot of really tempting stop order trades that ended up not working out so well. So, this is a difficult day, I think at least. But that's just my opinion. Bar one, a big bull bar closing near its high. We're accepting the gap. So whenever you get a gap up like this, and you get a bull bar, it shows that the market is accepting that gap up. A big reversal down on bar two, closing near its low, but not really all that good. It's a potential high of the day, but I probably wouldn't sell it. I think that, it's better to wait for follow through. And if it's going to be a high of the day, you're going to have a lot of other chances to buy or to sell. And then look what bar three does. You can see it trades right back up to the bar one high, essentially. So the bulls who bought up here were disappointed in this. They were probably more interested in buying, maybe a 50% pullback somewhere down here. So they buy here, they scale in at 50%, and they're using the rally to get out around break even on their first entry with profit on their second entry. Two, probably enough for a second leg down, and four starts that second leg down. But big tails on both sides, triggers the low one, sell below three, really not all that good. Follow through on five, but it's really still not as good as it could be. And more follow through on six, but it looks climactic. And I would rather see, one more good bar. If the Bears get one more good bar, they might get some sort of swing down, but chances are they're probably not going to get it. And, essentially, this is not as important of a measured move, but it's just showing that, leg ones often project the size that the second leg will be. So your leg one was bar two, right? And the size of that opened to here. And that's about how big the second leg down from 4 to 6 ended up being. And anyways, but that's just important to realize that overall second legs a lot of time end up being the same size as first legs. 7 closing on its high. Do you buy above 7? I think it's a credible buy for maybe 40% chance it's the low. Maybe 30% chance it's the low of the day. 35. One of the main reason to buy would be you're looking for a second leg up from the gap in bar one. So when you see a big gap up, you can think of it as just pretty much a giant bull bar. So giant bull bar and bull bar one, pull back and high one buy, reasonable swing buy above 7. Good follow through on 8. You can see the bears who sold to close a 6 are disappointed in how 7 closed, and they used the tail on 8 to try to get out. But this was such a bad close against them that a lot of them just exited with a small loss, and that's part of what caused 8. It's reasonable to buy above 8, but you're buying pretty high in a potential trading range. So it might be better to wait for see if you get one more bar of follow through. Bar 9, a big tail on the top, so hard to want to buy there. And bar 10, follow through for the bulls, but not really as good as it could be. Big tail on the top as well. And then 11, you finally get the good follow through, but bar 8 looks like a spike. Bar 9 and 10 look like a channel, and so 11 looks like a climactic breakout attempt above a channel. It's still reasonable by the close, and it's not wrong to buy. But if you buy, you got to be quick to get out, like below 12. 12, it's a big low 2 on the open. I wouldn't sell it after all of this because this is actually a really interesting tight trading range, I think. So it was possible that we ended up getting essentially this and then a pullback and then a second leg up. The bears who sold below 12 knew it was a low probability trade and that they were going to have to sit through something very sideways in order to potentially make a profit. So you get a pullback 12, and what do the bulls see? The bulls see, I'm just going to talk about this whole section as a whole first before I go through it individually. But once you get to here, what do the bulls see? Well, the bulls see a spike and a wedge pullback, 1, pullback, 2, pullback, 3. Sorry, 1, pullback, 2, pullback, 3. And the bulls want a swing up essentially. So they're on their third attempt up and they want, a swing and breakout to a new high and a measured move up. What do the bears want to see? Well, the bears want to see a failed breakout above that, which is what they end up getting. And you can see this ends up being actually a wedge pullback for the bears. So this is what the bears, they started the swing below 12. They knew it was going to go sideways. So it goes sideways, 1, pullback, 2, pullback, 3, and then we get the breakout to the downside. And it's interesting because if you're going to take a buy like 18, I don't think it's incorrect to buy 18 betting on a wedge pullback, but you have to realize you're trading in a tight trading range. And when you're trading in a tight trading range, you're going to get a lot of failed breakouts. So take a look. Let's say you bought one tick above the high of 18, right? You're in right here. And if you're doing that, you probably don't want to have a stop below 18. You probably actually want to buy more below 18 since it's a good bull bar. And look exactly what happened here. The bulls, they bought above 18. They got a bear bar 19, but they knew that it was most likely that they were going to get a disappointing bar. And so they bought more below 18 during 19. And then you can see exactly where 20 is the midpoint of those two entry prices. So they bought here, they bought more. And then as it rallied back up, they just flattened at their entry price. And that's what causes essentially 21, right? Is you started to get sellers here, so it didn't close on its high. And then at the end of the bar, everybody dumped. And that's what caused 21. But long story short, big low 2 on 12, follow through 13, not that great. Second leg up, 14, touching the 11 close. And, that's really all you have to get for a second leg. Even you could argue the tail on the top of 13 could qualify as a second leg if you continue to go sideways. But like I said, wedge pullback for the bulls, but ends up being a wedge pullback for the bears. And disappointment on 20, big bear bar 21, but a tail on the bottom. So I'm not really sure I want to sell down here. I'd rather wait for a pullback. It's kind of getting difficult at this point. I started to think we might have to go down, but I wasn't sure how far we were going to go down. And the follow through on 22 doesn't really help. It's disappointing. Big tails 21, 22. So high, I would argue it's probably a high 1 on 22, but it's not very good because it's a bear bar. 23 triggers the high 1 above 22, but it ends up basically right at the tie of the bar. It's not very good. An inside bar on 24, but even if we trade above 24, maybe you're trading for a second leg from 7 to 11, but I don't really think we're going to get a big rally here. I think if we were going to get a rally, we would have probably already gotten it. So, it might be a trading range and we might have to get up to the 21 high, which is the most recent sell climax, but I don't think we're going much higher. And you can see it never even triggers. Bear sold to close 24, doesn't trigger. Big bear bar closing near its, below its midpoint 25. 26, a reversal up, but the bar is really big. So even if it closed on its high, I wouldn't be super interested in it. And, one of the reasons is you're buying towards the top of the most recent sell climax, the 25 high. It's a high too, but the bear channel down from 19 to 26 is relatively tight. So it's hard to want to buy up here. Buy up here, I mean, towards the top of the bear channel. So bad follow through 27, 28, a bear bar, but not really able to close near its low. So not really all that enticing to sell. More follow through on 29, but again, a big tail on the bottom. So it's a potential wedge 1, 2, 3, or ended up being whatever 1, 2, 3, 4. But none of this looks all that great to sell. None of it looks all that great to buy. It looks like a bear leg in a trading range. And so bears are hoping for a swing, or so bulls are hoping for a swing up, but we'll see if they end up getting it. So you essentially, you get bad follow through for 29 on 30. You get disappointed bears buying back shorts. 31, a bear bar closing kind of near its low. It closes below the low of 29, which is important. And bears are hoping we're going to get a breakout below the 18 bar range and a big move down. The only problem is, if you're selling here, this is why we ended up getting this tail, is because you're selling right at the 6 close. And there were bears who sold the 6 close, scaled in higher at the high of the day, and now are trying to get out down here. There were traders who did that. And, it's disappointing for them. So they're probably going to exit. That cost us 32. It's a wedge, 32. So I think, the wedge, I would look at it as 22, 25, 32, or 31, I guess, but inside bar 32. So good follow through on 33, but look at how tight the bear channel was down to 32. It's too tight to be trading against it. So I don't really think that buying above 33 is going to be all that great. We didn't even end up triggering it, but I think, this is just so steep that we're probably going to end up getting bad follow through if we try to rally above 33. And that's why you get bad follow through on 34. 34, an inside bar. It's a low 1 short for the bears, but 32, 33 strong enough for a second leg up. I'd rather be flat. At this point in the day, your plan should be you want to sell at a big bear bar closing near its low as we're trying to break out below the range, or you want to get a pullback and then a reasonable buy setup. Inside bar 35 as well. You sell below 35. I don't think you take the sell below 35. You probably can. It's an II 32, 33, and maybe a reasonable sell 35. But it's just kind of hard to want to sell this with how this day is traded. I felt like if the bears were going to get that breakout, they would have probably already done it. So they need to prove it to me again. And one of the ways they could have proved it was on 36. You get a big bear bar that looks maybe like 40. That's closing, hopefully, ideally down here, but even closing in here is probably okay enough to take it for a swing. they don't get it. They get a disappointing bar with a tail 36. 37, maybe the bears are going to start to win with time instead of, price, right? So maybe if they get enough bear bars, bulls will start to give up and we'll get just a big collapse, essentially, is what you're hoping. And you get another bear bar on 37, kind of disappointing, but good enough. And so you're thinking, okay, well, if we get one more bear bar, I'll sell, right? So you have four. You're thinking it's enough for a second leg, but if we get a fifth bear bar, we're probably, bulls are probably going to start to give up because it's pretty unusual to get 5 bear bars. And instead you get a doji bar, 38. So bears just not quite doing enough to make you want to enter the trade here. And that's the, moral of the story in trading range days is there's always something really wrong with stop order trades. Outside up 39 was good for the bulls. If it closed on its high, it's probably a credible swing buy. But the problem is 4 bear bars and the 33 close. Traders who bought the 33 close are going to be disappointed in the sell-off, so they're going to look to get out. But I think if it closed on its high, reasonable swing buy, but it doesn't on 39. So the traders who were buying, hoping to basically front run it, are disappointed in the close of 39, and they're flattening, and that's what's causing 40 to close near its low. I think 40 is a credible sell. This was a wedge, right? And we tried to get two reversals up in the wedge. First reversal, pullback, and then second reversal. So we tried to get 2 reversals up. And so it's a credible sell below 40, looking for a measured move down. That was another measured move down. The spike ended up being the same basically as the wedge. But overall, you can use either measured move. But I think that 40 was a credible sell, looking for a breakout below and potentially a move to the prior day's high. It was probably out of reach, but it was, it was possible, I thought, especially with the context on the daily chart being, we're in an area up here where we're probably going to end up finding sellers. We might have to get back to this high. 40 follow through for the bears, 41 follow through for 40, but it's really not that ideal. It's okay. It's good enough for sure to stay short. But if you sold below 40, you really wanted to see 41 look more like 50 did. So you wanted to see 41 look something like this. And instead you get the big tail. More follow through on 42, but it's just okay. It's not great. You wanted to see follow through 42 again, looking like 50. That's the ideal bear bar. So the bears keep being 1 bar away from, the market's clearly always in short. It never probably really, it probably flipped always in short somewhere in here. It never really went to always in long. Most of the rest of the day, it was right as it became always in long, it flipped back down. So it was really never all that clear today, which is the problem with trading range days. But follow through on 42, but still a tail on the bottom, doesn't close to a new low. And then 43 outside down, good enough for the bears, hoping that we're going to trigger the sell below 43 and start to collapse, basically, was the goal. But instead, we end up getting a disappointment bar 44, an inside bar 45, probably buyers below. And you can see that any bears who were selling down here were just using the sell-off to get out. And that's what caused the rally on 47. 47, a good bull bar, potentially a swing buy. You're hoping you're going to get back up to at least here and maybe, get a whole second leg up from this earlier in the day and maybe even from the gap, right? So gap and then big pullback and then maybe another leg up. But you probably want it to start to happen rather fast. And 48 is just not ideal enough follow through. If you bought above 48.7, you probably wanted 48 to look like 47. And instead, you get this bull bar here with the tail on the bottom that's, shrinking body. And the biggest problem with this is if you're buying above here, you're buying right at the high of 40. And 40 is the most recent sell climax. So buying above 48, you're buying a bar with a shrinking body at the top of the most recent sell climax. So it is a pair of bull bars, and it's probably always in long, but it's just hard to be long up here. And then you get an outside down bar 49. You know that any bulls who are long are going to exit, and 49 is a double top bear flag with 40. So I would say, about a 40% chance that we get a breakout below, a measured move down somewhere down here. Again, another measured move spot we hit. And instead, 49 closing near its low. It's an okay sell below 49 for a swing. Follow through 50. It's still an okay sell for a swing, but you're selling right down here where some traders will be buying back shorts, and you're selling right at the neckline. So you're hoping 51 is going to be good follow through, and instead you get a really disappointing doji bar. Because trading range days, that's what's going to happen. 52, a bull bar closing near its high. Bears will probably start to exit. You can see they got a second leg down, 53, that basically touched the low of 50. So like usual, I would argue a lot of bears, so they sell, they're disappointed, they're getting out, the tail causing 52. Some traders wait more, and then they see a bull bar closing near its high, and then they use 53 to get out. So traders have a couple chances to get out here. In a trading range, bears know that this is probably a trading range at the worst case. So even though they're selling low in the trading range, they're confident they can scale in higher. But what you can't do on days like this is sell, buy above 48, put a stop down here, get stopped out, sell below 50, put a stop up here, get stopped out, because it's this what trading range days do. They run weak stops constantly. You can see we ended up having somewhat of an expanding triangle towards the end of the day, and we tried to get a breakout below it. But anyways, 54 closing near its high, a good bar for the bulls, but you know that there are traders who bought below 48, disappointed 49.50, hard to want to take anything there. Follow through for the bulls 55, 56, but big tails on 55, big tail 66. This is not ideal. This looks like the middle of a tight trading range and really not something I want to trade. Reversal down 57, but tight channel up, right on a flat moving average, right in the middle of the trading range. I think I'd rather wait. A bull bar closing near its high on 58, yes, but again, look where you are. 52, 54 through 56, and now 58. So that might be 3 pushes up in a trading range. So it's still, none of this is ideal. 59 trades below 58, finds buyers right at the moving average. Not too surprising, essentially a high 159. And a big bull bar 60 breaking out to a new high. It's a climactic breakout above the channel. So you have a wedge, 1, 2, 3, and the bulls want a breakout above and a measured move up somewhere up here towards, maybe this area. Because it was reasonable to buy up here, so it's possible we might have to try and get back there. But instead of getting big follow through on 61, what do you think is going to happen on a trading range day? You're going to get bad follow through 61. 62 trades back up to right above 61 and then sells off. So the bears or any bulls who front run it, disappointed 61, exiting 62, and then you get a massive dump 63. Any bulls front running, hoping that 62 is going to close on its high, disappointed 63. And just all bulls will get out below 62, I think, since, climactic breakout attempt 60 and it's failing. And it's a possible expanding triangle. So they're going to get out. 64, a bull bar closing near its high, maybe a credible buy, but, just nothing is getting good follow through today. And if you're buying pretty much right in the middle of, the trading range over the past 30 or 40 bars, maybe like the past 20 or 30 bars, but you're buying right in the middle of a trading range. So it's really hard to want to do. You get bad follow through 65. Now what do? Bull bar 66 outside up and an inside bar 67. So IOI, theoretically a buy above 67, but right on a flat EMA in the middle of the trading range. I don't want to do anything. Bull bar 68, but we're end up just texting the 62 close basically. Why the 62 close? Why are there sellers here? Because, it wasn't a great bar to sell below. It wasn't great to buy below, but some algorithms will do it. And they scaled in lower. They scaled in at the new low of the day. And they're using this rally to sell out of their longs. You get 3 pushes up. And bears trying to get something to sell, but never really do. And then bear bar closing near its low 77. Like I said, I think these are the most difficult days for stop order traders. I think if you're, one of the things I'm working on is there are certain days where you're going to start to get swings and there's potential to make a lot of money. And there are certain days where it's just, if you can leave break even, first, I did not break even that. I lost. But this is one of those days where I'm just going to kind of look at and be like, yeah, if you can leave here with a small loss or break even, I would say, your job is done. Definitely if you can leave this day break even, your job is done. But as someone who's trying to trade always in, if you just leave, even with a small loss today, it's probably okay. This is not a great day for stop order traders. With that being said, reasonable stop orders, probably 7, probably 8, 11. I want to say 18, but I'm not sure. 40 was my favorite trade on the day, I think. Maybe 35, but it's just lower probability. I think it's better to wait. I think 40 is a much better sell. Maybe 47, 48, but really hard with the area you're in. You need to be quick to get out. You can sell below 49, 50, but got to be quick to get out. Can't take a full loss. And then maybe, 64, but I don't want to, do anything. On the daily chart, it's a double top for the bears. So you could argue double top bear flag with this, and the neckline is down here. So 40% chance that we get somewhere down here, basically, back down towards 5,100, more or less. Probably, I wouldn't be surprised if there were sellers below this low tomorrow. This is a credible sell setup. So, it's always possible that we get some sort of collapse tomorrow. So I would be really aware of this low tomorrow. Basically, today's low, I'd be really aware of that tomorrow if we trade below it and we start to find sellers. And I would be really aware of this high as well, because the bears who sold above this high might be a bit disappointed in this. So it's possible there's going to be support at this high, tomorrow. Let's say, again, assuming no gap. You find, we trade below this, we find sellers, but we might end up trying to get some sort of reversal around this high. So I would be aware of that price too. But ultimately, I wouldn't be surprised if we got good follow through for the bears tomorrow. It's low probability though. It's probably a 40% trade after, this is a climax. So it's a climactic breakout above this channel and a reversal down. So in theory, 70% chance you're going to test the other side of the channel. So again, I think we're probably going to pull back here pretty soon. Moral of the story. The weekly chart, bears, again, really want a bear close. This was not an impressive bull close. If you're a bull, you're not super, you weren't jumping up and down about how strong, this was. It was just, but it was a bull close. So it's still marginally more bullish, but really not very good. Really not overall that good for the bulls. So I'm expecting, sideways to down this week. I believe that is it. Yeah, that's today.